The crowd is panicking as gold evaporates 2.5% of its value in just a single week. But do you know why the sharks are quietly placing massive buy orders right beneath your feet at this very second? Look at the headlines. They'll tell you gold is slipping. They'll show you spot prices struggling between $4,690 and $4,710. They'll talk about a broken rally. But what if I told you that what you're seeing isn't a market collapse? What if I told you this is a financial crime scene, meticulously staged, highly effective, and designed to do one thing: take your position? This isn't a standard price drop. This is a margin flush, a brutal, calculated purge of leveraged traders designed to clear the path for the next massive growth cycle. In today's video, we're moving past the surface-level news. We are going deep into the order books to decode the liquidity trap that just caught thousands of retail investors off guard. We're going to look at the iceberg orders, the hidden footprints of smart money, and the real reason why a surging US dollar is being used as a smokescreen for the biggest accumulation phase of 2026. If you've been feeling the urge to sell, or if you're wondering if the gold bull market is officially dead, stop. Before you click that button, you need to see what the heat maps are actually screaming at us. Let's go behind the curtain and analyze the anatomy of this liquidity heist, and more importantly, how you can move from being the prey to becoming the observer. To understand why this is a massive trap, we need to look at what exactly happened at that $4,690 level, the place where thousands of retail accounts were wiped out in just a few hours. Let's break down the crime scene. Last week, gold didn't just slip, it fell 2.5%, slicing through a multi-week rally like a hot knife through butter. To the average trader looking at a basic chart, it looked like the end of the world. But if you zoom in on the data between spot gold trading at $4,690 and the futures markets hovering around $4,710, you'll see a massive disconnect. This disconnect is where the margin flush lives. So what is a margin flush? Imagine thousands of retail traders, people like you and me, all betting that gold will go to the moon. To maximize their gains, they use leverage. They borrow money from the broker to buy more gold than they can actually afford. Everything is great while the price goes up, but the moment the price hits a certain pain point, the broker steps in. If the trader doesn't have enough cash to cover the loss, the broker force sells their position at whatever the market price is. Now, think like a shark for a second. If you want to buy a massive amount of gold without driving the price up against yourself, you need a lot of people to sell at the same time. You need liquidity. And how do you create liquidity? You trigger the pain. By pushing the price just enough to break that psychological support at $4,700, the big players triggered a domino effect of automatic sell orders. As the price hit $4,690, the stop losses of retail traders were hit one by one. This created a waterfall of selling pressure. To the uneducated eye, this looks like a market crash. To the smart money, this is a liquidity event. They aren't panicking. They are standing at the bottom with their buckets open, catching every single ounce of gold that retail traders are being forced to throw away. Look at the futures data. While the spot price was slipping, the volume in the futures market was spiking at those exact lows. This is the smoking gun. It shows that while the weak hands were being flushed out, the strong hands were absorbing the sell-off. It's a classic play. The market moves in the direction that causes the most amount of pain to the most amount of people. If everyone is long on gold, the easiest way for the market to move is down, just long enough to liquidate those positions and reset the deck. Are you starting to see the pattern? The 2.5% drop wasn't a change in the global economic story. Central banks didn't suddenly stop wanting gold. Geopolitical tensions didn't just disappear overnight. The only thing that changed was the technical structure of the market. The rally was too crowded, too many people were using too much leverage, and the market needed to breathe. Or, more accurately, the sharks needed to eat. When you see the price breaking a multi-week rally, don't just look at the red candle. Ask yourself, who is losing money right now, and who is profiting from their panic? Because at $4,690, the answer was very clear. The retail crowd was providing the exit liquidity for the institutions to enter at a discount. This is the cold, hard logic of the exchange. It's not about right or wrong, or what gold should be worth. It's about where the money is trapped. And right now, thousands of retail traders are staring at their screens, wondering where their capital went, while the smart money is already looking at the next leg up. But here is the real kicker. While everyone was distracted by the price drop, something even more interesting was happening behind the scenes in the US dollar index and the hidden iceberg orders that most traders never even see on their charts. If you think a 2.5% drop is scary, wait until you see how the big players use invisible orders to hide their true intentions. Because the crime scene we just analyzed at $4,690, that was only the distraction. The real move is being hidden in the heat maps, and that is exactly what we're going to expose in the next part. But if you think this price drop means gold is losing its intrinsic value, you are dead wrong. It's time to look deeper than a simple candlestick chart. Let's talk about the invisible fingerprints of the giants, what we call iceberg orders and the liquidity heat map. Imagine you're looking at the ocean. You see a small piece of ice floating on the surface. That's the order you see on your public Level 2 data. But beneath the surface lies a massive, heavy mountain of ice that can sink the Titanic. In the world of high-frequency trading, institutions use iceberg orders to hide their true size. They might want to buy 50,000 ounces of gold at $4,690, but they only show 100 ounces at a time to the public. Why? Because they don't want you to alert you. They want you to keep selling so they can fill their massive bags at a discount. Now, look at this heat map. Do you see those bright, glowing orange zones stacked right around the $4,680 to $4,700 range? Those aren't just random lines. That is institutional gravity. It's a concentration of limit orders waiting to be filled. While the retail crowd was hitting the sell button in a panic, the heat map shows us that the smart money was standing there with a giant net. They weren't chasing the price, they were letting the price come to them. But I know what you're thinking. Wait, if the world is so chaotic, with geopolitical tensions rising and supply chains breaking, why on earth is gold falling at all? Shouldn't it be skyrocketing? It's a fair question. And the answer lies in the global tug-of-war between gold and the US dollar. You see, gold is priced in dollars. When the US dollar index, the DXY, and treasury yields surge, as they have been doing lately, it creates a massive gravity that pulls gold down. In 2026, the dollar isn't just a currency, it's a weapon of liquidity. When investors expect the Fed to keep rates higher for longer, the opportunity cost of holding gold goes up. Big money temporarily shifts into cash and carry trades or high-yielding bonds, squeezing gold's neck. This creates a massive paradox. The geopolitical case for gold is stronger than ever, but the monetary environment is creating a temporary headwind. The sharks know this perfectly well. They use the strong dollar as a smokescreen. They let the DXY do the dirty work of depressing the gold price, and while everyone is distracted by the strong dollar narrative, they are quietly clicking the buy button on those icebergs we just discussed. Think about it. Why would central banks, from China to the Middle East, be accumulating gold at record levels if the rally was truly over? They're not looking at the 2.5% dip last week. They're looking at the 10-year horizon. They're looking at the debasement of fiat currency. To them, $4,690 isn't a scary breakdown. It's a gift-wrapped entry point provided by panicked retail traders who can't see past their 15-minute charts. This is the divergence you need to understand. On the surface, the dollar looks like the king, and gold looks like the loser. But beneath the surface, in the realm of the heat map and the hidden flow, the ownership of gold is moving from weak hands to strong hands. It's a massive transfer of wealth happening in real time, disguised as a minor market correction. The smart money is playing a game of chess, while the retail crowd is playing a game of don't get hit.
By understanding the iceberg, you stop reacting to the price and start reacting to the intent. You stop asking, why is it falling, and start asking, who is waiting to catch it? But identifying the trap is only half the battle. The real question is, how do you position yourself so you aren't the one being liquidated next time? How do you build a portfolio that survives these margin flushes and actually profits from them? In the final part of this breakdown, I'm going to show you the predator's strategy, the specific steps you can take to stop being the prey and start moving like the giants. We're going to talk about how to build your own personal index and why the shift from software to hard assets is just getting started. Don't go anywhere. This next part is where we turn this analysis into your personal roadmap. Now that we've exposed the invisible orders and the traps laid by the giants, it's time for the most important question. How do you stop being the prey and start moving like a predator? The first step is recognizing herding behavior. Humans are biologically wired to feel safe in a crowd.
When the price of gold drops 2.5% and the headlines scream collapse, your brain's survival instinct kicks in. It tells you to run, to sell before it's too late. But in the financial markets, the herd is usually being driven straight into a slaughterhouse. To be a predator, you have to disconnect your emotions from the ticker. You need to stop looking at a 2.5 to 5% drop as a loss and start seeing it as a structural calibration. Look at the World Gold Council data for 2026. While retail traders were panicking at the $4,690 level, central banks, especially those in the BRICS nations, were doing the exact opposite. They aren't trading gold, they are accumulating it. They understand that in a world of de-dollarization and massive debt, physical assets are the ultimate insurance policy. They don't care about a one-week dip, they care about the next 10 years. So how should you allocate your capital when these margin flushes happen? First, stop using excessive leverage. Leverage is the scent of blood in the water. It's what allows the sharks to track you down and flush you out. If you own the asset outright, a 2.5% drop is just a blip on the radar. But if you're 20x leveraged, that same drop is an extinction-level event. Second, you need to adopt a personal indexing strategy. In the past, people blindly bought software stocks or tech ETFs, but the world is shifting back to the physical. We are entering an era of hard assets. Whether it's gold, silver, or the copper that fuels AI infrastructure, these are the pillars of the new economy. Instead of trying to time the bottom perfectly at $4,690, start scaling in. Think about it this way. If you liked gold at $4,800, you should love it at $4,700. If your thesis for owning it hasn't changed, then the price drop is simply a discount offered to you by the market's most impatient participants. The goal here isn't to get rich quick by catching a 15-minute pump. The goal is to build a fortress. A predator strategy is built on patience and position sizing. You wait for the liquidity events, the moments of maximum pain for the herd, and that is when you deploy your capital. You don't chase the green candles, you provide liquidity to the red ones. Transitioning from a retail mindset to an institutional mindset means moving from what if it goes lower to how much can I grab if it does. This shift in perspective is what separates the people who fund the market from the people who profit from it. You have to realize that the volatility is not your enemy, it is your best friend. It is the mechanism that transfers wealth from the people who don't understand the game to the people who do. We've analyzed the crime scene, we've tracked the iceberg orders, we've seen the central bank's playbooks. Now the choice is yours. Are you going to keep following the herd every time the price slips? Or are you going to stand your ground and build your wealth alongside the people who actually run the world? The era of easy money and software is over. The era of hard money and strategic accumulation is here. And as we wrap this up, I want to leave you with a very specific challenge, because understanding the trap is one thing, but having the courage to act when everyone else is running is where the real money is made. Let's bring this all together and talk about what happens next for gold and your portfolio. At the end of the day, that 2.5% drop in gold wasn't just a number on a screen. It was a psychological stress test. The market has a brutal way of separating the tourists from the owners. While the surface-level news was busy scaring you with talk of a broken rally, we saw the truth. We saw the margin flush, we tracked the iceberg orders, and we recognized the heavy hand of central banks quietly absorbing the panic of the herd. Remember, smart money buys when you are afraid, and they sell when you are greedy. Don't let yourself be swept out of the market by short-term technical noise. This is a game of conviction played on a chessboard that spans years, not minutes. If you understand the liquidity trap, you no longer fear the dip, you welcome it. You start to see every red candle not as a threat to your capital, but as a direct transfer of opportunity from the panicked to the prepared. So here is my question for you in this current correction. Are you choosing to be the one cutting losses to save what's left? Or are you the one patiently waiting at the support levels alongside the world's largest institutions? Do you see a breakdown or do you see a bargain? Comment the specific price level where you believe gold will see its most powerful bounce back. I want to see who's actually watching the charts and who's just watching the news. If this deep dive helped you see the market through a different lens, hit that like button and subscribe. Let's keep moving with the giants. I'll see you in the next analysis.